Morning, everybody. My name is Jeremy from Phillip Research. Today we'll be looking at Singapore banks, and we'll be looking at two questions, which is quite popular these days, which is basically the sell-off in December and January this year, being followed by payment collapse, and second is interest rate hike necessarily good for the banks. So in this presentation, we will discuss these two questions. So for the first question, the Singapore Bank showing similar signs in 2008 crisis. For that, we will look deeper into the non-performing asset classification. That's an extension of actually seeing the NPLs growing. So what we can say here is that under normal circumstances, right, the NPA classification should be stable. So in any shock or crisis, the percentage composition of each NPA classification will change, right? So we will look at each component, how fast it is rising, and also at the speed at which it is. We'll look at each component as in how is it rising in comparison to the rest of the other components, and also the speed at which it is rising over the quarters. This will help us understand if the credit risk assessment is in control of the situation. The second part is that we will also pay attention to the not overdue non-performing assets. The not overdue non-performing assets capture loans that are not due but are allocated to NPA. If the not overdue NPA rises faster than the rest of the other components in the aging ladder, we are concerned that the present credit risk assessment has not been adequate in capturing the market risks that are developing. This will imply that the risk management assessment is not adequate for the crisis that is actually forming. So the second part, the interest rate hike, is it a good thing? It is in close relation to the first question. We believe that the interest rate is actually a symptom of various conditions that isn't really negative. So this will actually impact how we will see the potential crisis. So first, before we look at NPA classification, we look at what's the definition. So if we see that the substandard classification is concerned with the economic and market conditions, the profitability and of the company, and the financial condition of the company. So in the first quarter earnings for OCBC, the CEO has been forthcoming to describing how the NPAs are for the oil and gas exposure. So he has mentioned that 59% of the NPAs associated with commodities and oil and gas, they are still servicing the principal and interest payments. And the other 38%, right, is actually servicing the principal payments, but they have suspended the interest. They have suspended the interest payments. So what it means is that in the substandard category, the credit risk assessment is in control of the situation, in the sense that they deem that these loans might be impaired, but they are not completely non-performing. So if the situation is in control in that sense, it is a little bit different from what we can see in 2008, where the credit deterioration is not in control, or the risk assessment is not in control of the situation. So the next we'll look at doubtful and loss. Of course, doubtful would be the loss given default, right, where actually the recovery of the assets that is collateralized is questionable. So under this kind of circumstances, of course, it would imply that the deterioration is a lot worse, right? And loss is that the outstanding credit facility is not collectible at all. So okay, from here we can see that, right, from the formation, NPA, in the last, in the third quarter of 2015 and the first quarter of 2016, where you get the severe sell-off, the NPA has been growing a lot faster on a substandard level, which corroborates with actually the management guidance that they are managing those loans, and they are within, and of course the formation has been growing in the substandard category and has not gone into or deteriorated into the doubtful or the loss. It's very different from the 2008 pattern, where you see that the doubtful, the percentage composition of the doubtful, right, exceeds the substandard at a very short period of time. And also the not overdue NPA for the last two quarters has been coming off, right? It goes to show that most of the bad loans that has been building up is actually moving up the aging ladder. And it also corroborates with the management guidance that they are actually supporting the existing business, and they are keeping a lookout on these businesses. And there's a right reason to do that also, because these businesses are still paying, a big part of it is still paying the principal and the interest. So you can see here in 2008 that for OCBC, the percentage of not overdue NPA is actually rising. So you have a larger proportion of not overdue loans moving into not overdue NPA. Well, within the both for the both periods, right, into the crisis period in 2008 and in 2015, late 2015 and early 2016, both NPAs are rising. So in a sense that the NPL ratio here rising doesn't really give us a very clear breakdown as to what really goes under the hood for the non-performing loans. So looking at the classification and analyzing the classification gives us a better idea whether or not they are. So this is for DBS. We can also see the same pattern forming here, right? And so is for UOB. Okay, so interest rate impact. Thematically, there's two ways where interest rate would rise, and recently these two themes will be first, of course, the capital outflows from Asia. That is in third quarter 2015, and then in the first quarter 2016, we have actually the guidance of Federal Reserve rate hike, which they had guided it to be 4 rate hikes this year. So the first part, where you get capital outflows, that is more episodic sort of shock, where there's capital outflows and the interest rates have to rise to stem that outflow. The other part about Federal Reserve guidance for rate hikes, that is the implication is more on a long-term development, and this long-term development would impact a lot on our investments. And here is what we're talking about. The prolonged QE provides fuel for the supply side economics, and what this means is that there's actually increased investment in fixed asset, right? It could be it's an over-investment in fixed asset, over-investment in productive capacity. And what we mean by fixed asset would be, a lot of funds have been channeled into property, real estate, and very popular is what we call a carry trade, where you borrow at a low interest rate and you buy into an asset that yields a high interest rate and you earn the spread. This side of the economics is not, we'll say they are not moving in tandem with the demand. Really, they have no idea what the demand side is. It's just a very reactive sort of investment where as long as you see a good yield and you can borrow cheaply and you just earn the spread. And it tends to overshoot and you tend to overinvest. And on productive capacity, there's actually, if you know that there's a lot of funds that will be invested into like offshore barges, oil producing capacity. So when the supply of this hard commodities go up without having the checks and balances on the demand side, you see that this productive capacity will be affected when interest rate rise, because most of the debt, especially bank loans, etc., bonds, they are used to fund all this productive capacity. So they become a lot more sensitive to interest rate hikes, and if the prices of these commodities come off, right, then it impairs the debt servicing capability of all these assets. So on the other side is the demand, right, which is developing on the opposite direction of supply. We see changing consumption patterns because of population demographics and digitalization and technological advances. So, for example, oil. If let's say we have a larger component of aging population, the consumption of raw materials, oil, commodities would fall off, right? And also at the same time, the kind of equipment that we use that will consume oil are actually a lot more efficient now. So all this points to the fact that there's a lot more output, right, for less oil, and that means is that the volume of oil, the demand will definitely not spike up as much as what we have seen probably 30, 40 years ago. Okay. Right, and there's also other. Okay, sorry for the interruption. Okay, so the other part about debt overhang, for example, you see that the nominal value of your loans are going up, right? And this makes the value of this, the profile of these loans a lot sensitive to a marginal increase in interest rates. So when we have a scenario where there's a large amount of mild investments, a marginal increase in interest rate would impact this debt servicing capabilities. And in the following charts, we'll show you the rising household debt to income and also the household debt to GDP of countries in Asia. Just to give you a flavor of that how sensitive these loans are to rise of interest rates. And what's the impact of this, right? So higher interest rates traditionally is positive, is viewed positive for net interest margins, and it is usually viewed positive for the banks. But in this case, we will see that the asset quality will also be impacted because of the presence of a lot of mild investments. Having lower interest rates are favorable now for the banks to raise funds cheaply. As you can see recently that UOB, they have issued a covered bond, that is a euro covered bond that is priced at 0.25% per annum, and that's actually very low. And most of the subscribers to this loan are European funds, right, because they have a negative interest rate environment at the moment. So what is expectation is that it's very important for for a gradual rate hike, and as investors, you should be paying a lot of attention to what the guidance will be, because the gradual rate hike gives the banks time to work through the quality of their loans. They can decide if they want to continue with certain businesses or they cut them out, and so by reducing certain exposure, they will be less over time. They will become less sensitive to interest rate hikes. So as long as the rate hike is gradual and they keep pace with the economic situation of the current economic situation, there will be less chance of a shock, right? So the next thing is about banks. What we are looking out for is the ability to maintain the NIMs or increase it a little bit by lowering the funding costs. So the ability to lower the funding costs is very important. And the next and final part is the Goldilocks interest rate. Okay, Goldilocks has been used to describe the economy as an economy where inflation is not rising too fast or is not too low. But in this sense, the Goldilocks interest rate would be to settle at the interest rate that does not allow malinvestments to continue at a high pace, as well as not too high to shake up the malinvestments and to create undue shock in the economy. So you can see here that it's a chart that tracks the STI index versus the 3-month SOR. So you can see the relationship here is very, very obvious, right? When during the August period in 2015, where there is capital outflows, the saw spike up, and there was a collapse in the STI. And subsequently, in December, Janet Yellen guided for 4 interest rate hikes this year, and with that guidance, the saw actually spiked up, and also we will see that in January there's a severe sell-off as well. So the relationship is very clear. So as for the loan books, what we'd like to highlight is that the US dollar and Chinese yuan denominated loans have declined rapidly, and that is because the US dollar, typically the commodity related loans are denominated in USD. So when this come off, you can see that they have taken steps to reduce the risk exposure to these areas. And the Chinese yuan denominated loans, okay, so for the banks, the exposure for Chinese yuan denominated loans for non-banks will be actually the state-owned enterprises, and for the bank loans is to the policy banks. The offshore borrowing costs after August 2015 spiked up more than the onshore, and so naturally that business would also come off. But also, in a sense, if you look at the risk exposure, people may have doubt over the amount of investments in China. So it is a good thing that this has come off. And while it's coming off, we know that the loans books are improving in terms of quality. So as long as this is stretched and the banks have time to manage this, we view that the tail risk, the probability of tail risk actually dwindles over time. So markets in focus now is that if we look at most of the geographical markets for our local banks, right, they have come off. China, Thailand, Hong Kong. So what they would try to look at is other geographical areas like Indonesia. Indonesia demographically is very favorable, and also on quality side, they will start looking at Singapore, right? Consumer loans, which is basically your housing loans, which still retains a high quality despite the fact that it can't be growing that much. So for DBS, it's a little bit more exciting. They have created the DigiBank in India, which is actually an online platform. And what is most favorable from the Indian landscape is that the Indian Indian infrastructure for internet, they have an open API where information can be shared readily, right? So in most countries, this API are held at private hands, and that's a problem for actually creating a seamless payment structure, online payment structure, because the APIs can't communicate each other. But in India, you have a public infrastructure for that. And also, they have the ADHA, which is actually electronic know your client infrastructure, and also a security authentication infrastructure. So they have a 12-digit authentication code for each citizen that is already set up. So DBS can leverage on this infrastructure to actually scale up using the digital platform. And that's on the back of very favorable demographics for consumer banking transactions and lending. India. So moving forward, what we would like to see is how they would develop themselves from using this platform into a deposit and lending bank. And if it and generally what the most of the income, right, uh, growth should come from lending, and that is actually a very big bulk. So as lending picks up, we will see that very, very positive for DBS. And here is actually the geographical breakdown. We can see that Singapore still retains a larger component of the loans. So while they are addressing the other geographic areas, for example, in China, the lending has mostly, I've mentioned before just now, that it is mostly to policy banks and to SOEs. That has to retrench because we know that a lot of malinvestments are in that segment. And what is favorable in China is actually the consumer loans. The household debt in China is very low, it's about 40% in 2014, and there's a lot of room to grow. And you know that the government has guided to engage the middle class in China and to grow up and to grow the consumption power of Chinese people. So it will take time for the banks that are operating there to transit into that area. So while it's transiting, it's inevitable that they have to rely on maintaining strong foothold locally in Singapore for housing loans. Unfortunately, that is what all the three banks are looking at. And so we feel that towards the end of the year, the competition will heat up for home housing loans refinancing. Okay, so this chart shows is actually to reiterate the points about debt overhang and how is it been growing. And the debt and this growing debt, right, is as we can see here pointed out, they are in the geographical areas of where our local banks are operating, unfortunately. So you can see that in Singapore, the household debt to GDP has risen from 50 to probably about 75%. So here's the problem, right? The household debt as a percentage of GDP, the GDP is not growing as fast, but the household debt is. So it goes to show that if you are really looking forward to household debt to grow further, it is not likely the case, right? Because of this overhang, it is not creating enough growth, or I would say is that it is not effective anymore to further grow that. Maybe perhaps, let's say for example, if the households are having a second home loan for rental, right? The rentals would not increase as much as the kind of debt they are taking on. So it makes it a lot tough for them to service the additional home loans. And you can see here, the second graph is the disposable income to household debt, and that has spiked up. In Singapore's context, it has moved up to above 160%. So that itself actually makes it a lot harder, right, for them to service that. And also, if the interest rates were to rise, it makes every marginal increase would have a more negative impact on the debt servicing capabilities. So our investment actions would be, considering the upside is limited, downside, just be very, very careful of the guidance and follow the interest rates and how it rises. A gradual rate hike should be okay. We should avoid a hard land from our STI context, a severe sell-off if interest rates continue to be stable. Yet we can see that geographically the growth prospects are muted, right? So we will not see that sort of growth prospects for new markets or their new strategies to form very soon. Will probably take about a couple of years or more. So for the time being, it's range-bound trading, and you can use CFD to short, but be careful of the ex-dividend period, and generally do not buy and hold. So you can see our target price is actually very tight. To reflect that it should be trading within that range, that tight range. So that ends my presentation. Is there any questions? You can type it in the question box. Thank you. Okay, we have a question whether slides will be sent out as usual. There's some changes to the procedure. We will be sending out the slides after the webinar instead of before the webinar. Thank you. Okay, we have a question where we can get the figures for credit classification and analysis. So this is actually available every quarter in the earnings report. So it is one of the slides that is within the non-performing assets. So after the NPL ratios, etc., then you can see that there's actually the classification, and you can look out for its breakdown into substandard, doubtful, and loss. And then also there's the aging, which is not overdue, then less than 60 days, 60 to 90 days, and then and 180 days more. Thank you. Okay, if there's no more questions, we will end the webinar. Thank you very much.